Connor Yost of Nucleus One Consulting, and this is Smoking Hot Topics, M&A, Investing, and Capital Raising, moderated by Frank Siegel. What is the state of the cannabis capital markets? What should investors be mindful of when making deals in the rapidly evolving cannabis industry? How has COVID-19 impacted finance in the cannabis arena, and what is coming next? Our panelists will discuss and share insights into these pressing issues confronting the cannabis industry.
Welcome back. This is not a rerun. I am hosting our last panel, and I want to welcome everybody and appreciate everyone with us since this morning. I'm just going to ask a technical question. Is everybody showing up on our panel? I see 3 people so far. 4. We have a large panel. This is the largest panel of the day. There we go. Just want to make sure. I know a few people were having problems logging in. Everybody? All right. So M&A, venture capital, capital raising, that's what we're going to address. We're really pleased and appreciate the panel that has been assembled here today and everyone spending their time. We really do have some of the top venture capital funds and investors ranging from seed capital to growth capital with us to introduce themselves, share their experiences, what they're looking for, what the capital markets are like today. Some great insight that we're going to hear. Because of the size of the panel, I'm not going to spend time introducing everybody. What I'm going to do is introduce them with a direct question, and our panelists will then talk about their fund, address the question, and also talk about what they're doing in the marketplace. And as always, I encourage my other panelists on any question to certainly chime in. What we've seen in the last year, what many people are experiencing, obviously, are very extreme times in raising capital in the cannabis space. It's never been easy. In the beginning, it was easier with a lot of companies using the capital markets to do so. And then several years ago, that dropped off from the face of the earth. We've seen significant volume down in 2020, capital raise, capital infusions by almost 50%. We saw stock prices drop almost 70%. They've been reset to a large degree and have come back. But capital is still a very scarce commodity in this space. Our panelists are people who fill that gap and will share with us their stories on raising capital, on implementing, investment procedures, and on deploying that capital across various companies and niche sectors in cannabis in general. Before, there definitely was smaller funds. In the past, there might have been a few $1 million to $10 or $15 million. Now that has significantly increased. And as Joe and Mitch were telling us, depending on the election, you could see a whole new wave of investor capital coming into this marketplace. So with that background, I'd like to introduce everybody to Jeff Finkel. Jeff is the CEO of ArcView Ventures and has a very unique fund that we're going to hear about called the Collective Fund. Jeff fills a critical, not even void, but a critical start in the capital raise, which is the seed capital. And they have done investments across the sector. And love to hear about what you're seeing, Jeff, how you guys are looking at deals and where you see the seed capital funds, if you see that as a space where we're going to see some significant growth.
Sure. Thank you, Frank. So again, Jeff Finkel. Can you guys hear me?
Yep.
Yeah.
Yep.
Okay, great. Jeff Finkel, CEO of ArcView Ventures. To Frank's point, we do have a unique fund. It is a member-managed venture capital fund. So it is the perfect hybrid between a traditional fund, GP, LP management company structure, and a loosely coupled angel network. Essentially, we're giving angels an institutional platform to closely collaborate, share diligence, and make better investment decisions. We have 55 members. We've done 11 deals. And while seed is part of our focus, we really view ourselves as seed and early growth. And we are actively investing today. To answer Frank's question directly, I think I'm not sure capital markets have completely recovered on the private side. I think more money is going into public companies, but on the private side, I think there's still a gap. And I think a number of the funds that were prevalent in 16, 17, and 18 that were, 15 to $40 million funds, a lot of them have spent their capital. They're reserving for follow-on for their portfolio. They're not doing too many new deals. And a number of them are out raising larger growth capital funds. So overall across the stack, Frank, I still think there's not enough capital for the deals that are out there that are worthy. But I will say this, I do see over time as the funds that had some success in those years raise their growth capital fund, that there's going to be a seed gap because a lot of them are abandoning the seed space. So I would argue that, except for 4 or 5 funds that we tend to co-invest with somewhat frequently, there really is going to be a big gap. It's not much different than the Series A gap in tech investing in 2012 when the SBIC canceled their program and Series A shrunk, and there was certainly crowdfunding and a robust angel market. We're seeing something very similar. So I think that's what we're likely to see over the next few years.
So Jeff, talk about the collective fund, because that's a very interesting model that a lot of people aren't not familiar with and might actually prompt some new groups, to get into this space to do so.
Yeah, I mean, look, again, it's as I say, the hybrid between a traditional fund and a loosely coupled angel network. Our members, they're limited partners. We refer to them as members. Both are LPs and GPs. We allocate 1% of their capital to the general partner. And in doing so, they vote on how the fund is run and in which companies the fund invests. And to the extent that they choose to be active and sit on committees, they participate in a carve out of the carried interest. That sort of has served as the secret sauce to keep them engaged, to keep them recruiting and looking for good companies and being part of the decision-making process. It's kind of interesting. I really felt this structure was right for cannabis because, investing in cannabis is pretty hard, notwithstanding that we live in this gray area between state legality and federal illegality. It's really not one thing, right? It's really 12 distinct subsectors, each of which have different levels of financial efficiency, different timelines to exit, and different requirements for management skill set. It's really hard to be an expert in all of that. I mean, even in cultivation and retail, running a cultivation facility and a retail store are vastly different, and that's one group sector based on the way most of the states organize their licensing. So the collective fund, we're able to recruit, and within our membership body of 55 members, we have an expert on CPG. We have an expert on biotech and pharma. We've got a number of experts on the tech side, and we have a number of operators. So being able to leverage the wisdom of the LP/GP base, I think allows us to go deeper in companies, cast a wider net, and make better investment decisions. So it's great. And, our partnership is made up of domain experts. People come from financial services, operators, and then functional business experts, for example, in the area of marketing research or human resources. And it's really a good group that works pretty well together.
How has the pandemic affected your deal flow or the way that you're looking at making investments into these startups? And also, as a second question, what advice can you give those in the audience today who are submitting? We're doing our capital connection after this, which is certainly a unique approach to finding companies and connecting with capital providers like yourself. What what's the best advice you can give people as they're starting their ventures in the cannabis industry and trying to get in front of groups like yourself?
We're pretty visible. So in terms of access to us, we have a website where we accept submissions. We have a screening committee that takes the first cut, passes the ones that we think we want to engage with, of course, now digitally because of the pandemic, passes them through to an evaluation committee that further vets them, passes them to the full membership. And then if we decide to go further, we convene an ad hoc due diligence committee that writes and really does an institutional level due diligence exercise, which results in an investment memo that's sent out to vote. So we're accessible. You just have to go to arcviewventures.com. So finding us is easy. What we look for, some people in the seed game have a revenue requirement. I'm not going to look at a deal unless it's under $1 million. I wouldn't say that we have a revenue requirement, but we certainly have a data requirement. We want to see, particularly in the ancillary space, evidence that the market is ready for the product that the purveyor is creating. And sometimes that's evident in revenue, but it's not always evident in revenue. Somebody could have $1 million of revenue, but they're two $500,000 deals with somebody that's a personal relationship. And essentially, it doesn't speak for the industry. So you don't get comfort that they're at, that product market fit stage, and they're ready for their first level of scale capital to sort of build the business around the product. So for us, it's not necessarily about a revenue line. We do like to see some revenue, but revenue alone doesn't really tell the full story. We like to see teams that have really good founder market fit, right? So that the founding team is right for the solution that the company is creating. And we want to see a competitive defensive moat. We'd also like to see that this will be a candidate for growth capital going forward, because that's important. Not too many companies are going to kind of get to the finish line on a $500K to $1.5 million, traditional seed raise. How has the pandemic changed things? Well, I think it's made it harder for us just simply to get to know the companies well. We can't travel to see them. So we're relying on, largely a digital relationship. And that's made it a lot more awkward. Just overall, just changing very much the way that we vet and diligence, not having that sort of ability to freely travel and meet other than over a laptop.
Well, let's go to the other end of the spectrum, from seed to more growth. But Jeff, as you pointed out, a lot of the funds started out as seed funds, and that is creating a bit of a void. Cody Sanchez is the managing director of Entourage Effect Capital, one of the largest funds in the industry, and investing in various sectors. Cody, nice to see you again, and welcome. Maybe you can talk about, give us an overview, certainly, of the fund, and talk about, what capital raising has been like as you have been trying to fill up your second fund. And I know you're going upstream. Talk about the deals that you guys have looked at and why you are moving upstream, which is creating that void that Jeff mentioned.
Sure. So I'm going to keep it short and sweet since I know we're running a little bit behind schedule and I want everybody to get a chance to talk. In that vein, we're actually on our third fund. So, about $200 million under management. And what we're looking for is companies that have done more like $10 to $20 million in revenue. The interesting part that we found in the industry is that there's a lot of de-risking that happens the further down the chain you go with these companies. And right now it's our opinion that a lot of the early stage companies have an extreme amount of risk that is normal in seed stage, but that the opportunity, given the devaluation we've seen in the cannabis markets, is really located in these later stage companies that we can get at pretty incredible valuations in order to get to the scale that we think is necessary for legalization, or for when legalization happens, which seems a lot faster than we originally anticipated. So fundraising is always a blast in this crazy industry in which capital is constrained. But I would say that the interesting part about now is that when you have the ability to move against the grain, and you can put capital to work in an industry in which capital is the opposite of a commodity, that is when real opportunities happen for you to leverage your money.
What was the driving force? Was it just the returns, the amount of work that has caused you now to go more upstream and your checks are much larger size?
It's the evolution of the industry. In my opinion, a lot of the cannabis industry is not a venture capital industry. That early stage companies in much of the cannabis industry are better served by getting debt. And a lot of the industry is agriculture. So a grow probably shouldn't always be getting venture capital equity because the asymmetric returns that you can get are not high enough. And so, in our opinion, we're looking for companies that are later stage, that have already developed and grown to a certain degree, and that are big enough to allow for what, we're this mix of growth equity, venture, and private equity money in the door, without, trying to seek capital for a company up front that probably isn't going to be the 50 or 100x that most venture capital looks for.
How have you seen, there's been a major reset in valuations, maybe not so in expectations by entrepreneurs, but how is EEC looking at deals from a valuation standpoint?
Well, we had a valuation reset to the tune of 80 to 90% decrease in cannabis public markets since June of last year. And so we don't see that all companies realize that there's been a change in the world today, but that is the reality. And so when we go out and give people money today, there's a leverage that we've never had before as investors when the market was hot. And certainly, like, Emily, who's been in the industry for a long time, knows this as well. When we were all investing in 2013, 2014, 2015, it was very different than today. And so if you were an investor in cannabis today, there might not be a better time to put money into this market than right now where we're sitting. And so that's our belief and why we're moving much bigger dollars today than ever.
And have you started to see new investors coming in, or do you feel that they're still on the sidelines pending the election? I mean, how is your capital raising efforts going in this environment?
Well, I have to be careful about all the things we can talk about with a capital raise open, just from a regulatory perspective. So I can't really comment about that. What I will say is that, for the first time probably since the reset in the public markets, we're seeing very big checks come from very, very big players that aren't in cannabis, that are non-cannabis companies that are strategics in ancillary industries such as alcohol, pure beverage, CPG, a lot of family offices coming into the space in a bigger way. So, we expect over the next 12 to 24 months, the cannabis industry to be highly accelerated, whoever wins the election, to be perfectly frank. And we expect that those dollars will continue. But the really big dollars are not going to come in until legalization happens, in my opinion.
Mm-hmm. Do any of the other panelists have a view on that? Are you experiencing the same thing?
Yeah, I think there's a lot of exuberance around what could come of this election in terms of being a catalyst to open up more market potential. But I agree with Cody that I feel like this presidency has established a perspective and an outlook around the industry and has not really interfered with the growth of it, except for some of the things that were talked about in the last panel with AG Barr. But we had sessions to start this presidency, and that was certainly a grim outlook at that moment for the space. And I was quite concerned, but we've seen the gauntlet thrown down time and time again, and the industry just continues to rise up and push past it. And frankly, we can thank the constituents of each and every state that really advocate to make sure they have a legal and regulated market, because then that's what drives change at the top level. And so it's that kind of grassroots movement that's really been pushing this industry forward. So I'm pretty optimistic across the board. I think if things kind of stay the way they are now with the presidency and the administration, it's the devil the industry knows. If we have a shift in what everyone's talking about, this blue wave, then maybe it even opens up more growth and more opportunity. But we know how to navigate in either space.
Emily, I'm going to stay with you. Maybe you can talk about Poseidon. You were one of the first funds to launch, you're the co-founder with your brother. What I'd also like to talk about is, what you're seeing in the distressed area. We had a panel on distressed. A lot of funds are dealing with restructuring some of their portfolio companies. And is that actually, as difficult as it may be with your current portfolio, is that actually creating new opportunities that you might be targeting at Poseidon?
Yeah, I mean, since we've been investing actively in the space since 2014, we've seen a lot of ebbs and flows. And to Jeffrey's point, when we first launched, I would characterize our first fund as an opportunity fund. We did everything from growth capital to all the way down to the very first capital into a company at a concept stage. So we are really focusing on getting exposure to the different subsectors of the industry and making sure we had all of the derivative opportunities covered around cultivating, manufacturing, distributing, and retailing cannabis. And so, and we've done so globally, frankly. So we've seen how these different things have shifted. From a distressed point of view, I would say that Poseidon's portfolio is not really playing in that space. We're kind of just focused on building, and everything has been running. We've been focused on more modest operators in terms of the things they out in the world proclaim, and they've just been running. They have strong fundamentals. So from a distress standpoint, that's not really a space we're playing in too much, to be honest. And we've looked at quote unquote distressed opportunities in the cannabis industry, and I think that people jump into these things, and I don't think they're underwriting it with enough caution and understanding exactly how long the liabilities hang around on these entities. It's very hard to get into a distressed asset and kind of wipe away the things that could continue to repeat themselves time and time again. And it's actually something we work closely with Greg's team at CohnReznick. Like, we work with these different groups to help us to underwrite the process. And we've walked away from so many things because we feel like the long-standing liabilities that could continue to hold back potential attraction of capital into the business, potential scaling of the business. It's just not something we're looking to do with our second fund, which is what we're actively deploying capital out of.
Jeff, at Salvio, is that the case, or are you guys looking at distressed opportunities? Maybe just give us a brief background on Salvio first, if you could.
Yeah, sure. Thanks, Frank, and thanks to the Burns and Levinson team for putting this together. Jeff Howard, Salvio Capital. We're a Chicago-based traditional venture capital structured fund. Launched in 2016. Prior to that, just personally, I've been making some small investments with some personal capital in the space from like 2014 to 2016. But the fund itself, again, a traditional venture capital fund, Chicago-based. So fast forward to today, we have 21 companies in the portfolio across the whole entire ecosystem of, ancillary, non-plant touching tech companies that support the industry to plant touching brands, predominantly in Colorado and California. We did have some brand exposure in Canada that we got out of a a while ago, but and then lately the emphasis, at least for us, has been more on the MSO and FSO side of the space. So we feel we like other experts on the panel here have a good handle of the space and the different investment opportunities within the space. We're kind of like Emily. It sounds like at Poseidon. We're not at Salveo. We're not specifically looking for distressed deals. That's not. We do think there will be opportunity there, but there is a certain expertise that needs to go along with that. And also, there just need, the industry, in my opinion, from a distress perspective, it's just not to come out of something like that. It's just the industry's not deep enough to. It takes a lot to manage that. So we're not focused on that. We're focused on, growth equity and mid-stage growth equity capital.
So I throw this out to all the panels, and I'll introduce Paul Penny with Credit Force. Paul, maybe you can give a little background on that. Then I really want to hear about where you see the opportunities, where this panel sees the opportunities, or where they're focusing their capital. And Greg, certainly chime in. Cone Resnick, you guys are involved in a tremendous amount of these deals on the structuring side, so you're seeing that as well. But Paul, just give us a brief background on Credit Force. And Paul, by background, was one of the first, or maybe the first, stock analyst in the cannabis industry. So has covered this for many years and actually helped set some markets for the public companies. So you bring a unique, intel and skill set into the industry as well.
Great. Yeah, thanks, Frank. Yeah, so Credit Force is a diversified platform that houses a senior secured debt facility and also other things like advisory services, and we do some direct active investing in some verticals like payments and so forth. So it's kind of a diversified platform. For me, I've had a career on the sell side and the buy side, and what hasn't changed is just that deep dive, bottoms up, fundamental analysis. Of really getting to know a company from the individual drivers on both the revenue and the cost side. Not a shocker that most companies have kind of a roundup, rosiest scenario in terms of their business, and our job obviously is to replace that euphoria and subjectivity with common sense and objectivity. And then also for us, I have a long career on the equity side. And now wearing the debt hat, I think it's been a focus on the underlying collateral package and really protecting the downside versus what the upside is. It's a different mindset in terms of an equity investor versus a debt investor. So for us and for me, it's been a big shift to if things go wrong and the crap hits the fan, what is our protection? And in terms of on the equity side, where a lot of our deals do have a warrant component, I think the market has surely shifted in terms of just being more rational in terms of what kind of multiples we're looking at. And I think in any market, going back to the go-go days of the technology names, where things were priced on price to eyeballs and crazy kind of different metrics. Revenue multiples are less and less concerning to us. It's all about next year's EBITDA, and then really scrubbing what the business looks like in 2 to 3 years, and really what the underlying cash flows are for that business, and that takes a lot of work to really take that business from a bottoms up, and then really model out the business from a fundamental standpoint.
So, Emily and Jeff, as this industry has evolved, so have, as Paul just talked about, underwriting. How are you looking at deals differently today than you were before? And plus, your checks are bigger. So when checks are bigger, diligence gets more important as well. And are you, maybe you can talk about new terms or structures that you have developed over the last couple of years to address, some experiences from the beginning. Maybe Emily, you can start.
Sure. So since we're investing now at Series A or later stage companies, these are operators that are doing tens of million. Well, on the plant touching side, they're doing tens to hundreds of millions of dollars annually, and they're EBITDA positive. So it's just a completely different animal. And anyone who's invested on the plant touching side can speak to the number of entities that tend to be involved in these different companies. So we have a 3-page diligence checklist at the Series A. It gets longer even after that, and it runs through an entire review of everything from IP and everything that's occurred around the IP, the various entities. We've worked with Cone in the past to do a tax review, because once an operating company has been running and they've been generating basically any revenue, you have to be really mindful of any potential lingering tax liabilities, especially with 280E, and making sure that everything is clean around that, or if you're just preparing in the event of having a liability that you have to take care of. So there's a number of those things. As we've watched the market and watched the exuberance in the pricing ebb and flow over the years, we've also created different structures to help improve our entry point. So, for example, we've negotiated where if we can't get to an agreement on a valuation at the time of entry, we will create tranches of curable warrants, so that we get a better strike price on those warrants if the company should not meet their target revenue expectations or EBITDA expectations, whatever we set it out to be in the future. And if they don't get it, then we have the opportunity to exercise the warrants, and we can improve the cost basis of the investment, improve the entry point of the investment. But if they do hit it, then those warrants cure. And so we try to do it in a way so it's not really predatory, but that it is around alignment. So we've done certain things like that. We've seen different additions around liquidation preferences that can really be important to, again, to the structure and to the entry point. And then we've also contemplated doing tranching, and we actually have already done tranching of capital, where you agree to terms at the outset and you can establish a funding timeline to make sure, again, it's all about hitting the objectives that the company is laying out. And the way we feel about it is, if the company says they can do this and we underwrite to think, yeah, they can do it, but if X, Y, or Z should happen, they may miss, we're kind of protected on that downside. So we've seen a number of these things happening across the board. The other main thing I would say, that about 2 years ago, we really, really leaned in on the corporate governance in this industry. And I think that it wasn't just our industry, but the broader industry. I mean, everyone saw what happened with WeWork. I mean, that was, in my estimation, it was absolutely a corporate governance issue at the crux of a lot of the things that happened when you read some of the things that came out in the IPO underwriting process. But I think in our industry, just making sure that the board of directors is constructed well, where you have independence on the board, where you have that kind of governance that's overseeing the way that the company is being managed, and thinking about the fiduciary responsibility of that board and of the company to the investors, as well as to every debtor, creditors and employees, but just making sure that there is process around that and consideration around that. So that's been really important. And then I'll just say one final thing is that we have been doing, a review of financials going into these companies, not just taxes, but financials, but then also requiring that like an audit will be done within a year of the entry into the company, and certainly before the next round of financing.
Well, you actually hit on a very important point that I was going to bring up. I'd like to hear from Jeff on this. It is corporate governance. What you saw in a lot of these deals, and when I was talking about restructuring distress, we're seeing a number of those deals, and some of the biggest issues confronting the investors is that they didn't pay attention to the corporate governance and the control rights. So, Jeff, what are you seeing in that regard? With you, as Emily outlined very nicely, the kind of structures they're doing. What is Salvio doing with respect that has changed now from when you got into the business with respect to structure on returns, warrants, hurdles, and on corporate governance? Has that become more of a focal point, as I assume it has?
Yeah, and Emily did a great job of summing it up. I mean, how I would just describe it is, a lot of it's really just the same traditional VC type of negotiating. I mean, it's obviously the valuation and warrant coverage is two at the top of the list, and I guess liquidation preference, downside protection, pro rata rights. They're all part of the discussion. But I guess what the difference is two things. For us, number one, governance has always did, but has continued to be a major focus of ours in any diligence process that we do and any investment that we make. Obviously a lot of things depend on it, but we'll always negotiate for a board seat, for ourselves, and if not a board seat, a board observer seat, and if not that, then at least information rights, just so we can stay up on what's going on. A lot of back in the early days, if you want to call them those, back in 2015, 14, 15, 16, there just wasn't a lot of transparency into a lot of these early stage companies who weren't all that really professionally run. And so, we've tried to bring an institutional lens to that from an investor's perspective. Governance plays a massive role in that. And then what's changed, just in 2020 versus in years past, is just, the roles have reversed. I mean, someone mentioned earlier, from an investor's perspective, we're in a much better position from a negotiation standpoint than we were, a couple of years ago, when it was like, there was so much kind of, dumb money or bad money, I would call it, chasing any cannabis deal around. Founders and so forth got a little ahead of themselves in what they thought was best for the company, and that was either too high of a valuation or not enough attractive terms to invest to incentivize retail high net worth investors such as ourselves and others. And so we're in a much better situation to be able to negotiate and for much better terms in light of COVID and in light of the capital constraints that are still prevalent, not in all sectors of the industry. I'm happy to talk about that, but certainly on the private side of the industry, there's still a capital constraint.
Hey,
Jeff,
Frank, I want to add to
go ahead, Greg.
comment and Emily's. We've seen a dramatic shift as well, just in the last few years, in terms of terms and valuations becoming much more buyer friendly. So it's certainly valuations are down, but from a buyer's perspective, we've seen things that recently that we did not see 3 years ago, like sellers notes, earnouts, real refocus the fundamentals. I mean, we're working on deals right now where we're hammering on working capital to establish a peg to protect the buyer. So, I think we're going to see more of this as this industry matures. And so it's become really kind of a renewed focus, I think, of investors. It's something to be kind of looking out for.
Well, you get, Greg is one of the leading firms, particularly on the M&A diligence structure side. Are you seeing clients really paying a lot more attention? I mean, our clients are certainly to the diligence process than in times past, because the euphoria, not that it's not there, but as Jeff Howard said, it's the leverage has shifted. So are you seeing deals taking longer to get done, from the capital side?
Yeah, absolutely. 2 or 3 years ago, there was much tighter deadlines. There was the rushes to get deals and diligence done. And I think a lot of things were overlooked or perhaps let go because of the euphoria around deals. Now deals are taking much longer, and it's not just because of COVID. I think investors are just much more diligent and want to run things to ground. Exclusivity periods are generally longer and often extended until investors are satisfied around what we're coming up with. And the issues that we're identifying, they were there 3 years ago, but now they're really kind of dragging things out and causing deals to extend for sure.
Where are you seeing, and I throw this out, Greg, you can answer this, and I throw it out to the panel. Where is everyone seeing the best opportunities to deploy their capital, or are you still, not need to be use a pun, but high on which sectors? Is it flower? I mean, flower is very strong now. Is it grow that you feel is still where you're going to get the best returns, or are there other areas in the sector? And I throw this out to everybody, Paul, everybody on the panel.
I mean, I'll go. For us, it's state.
So,
Go ahead,
Jeff.
Go ahead, Jeff.
Yeah. So we're seeing the best opportunities in what I would call more broadly the science of the plant, areas in which are affecting yield and grow, ways in which to change the characteristic of how the plant is applied, biosynthesis to produce cannabinoids and not going through a growth cycle. We think that there's a lot of opportunity there. We still see some opportunity among emerging, let's say, properly structured states. We invested in actually a very interesting Massachusetts licensee at a very, very favorable valuation. Again, debt was not an option for this one, and it was a $1 million, $1,250,000 round. And she's killing it in the first 4 months of operation on very favorable terms. So we're still long there. But I would say probably the best opportunity, the one that's got us most excited, and though we haven't seen a ton of deals at seed and early growth, and just to set the record straight, we talk seed a lot, but we really are seed and early growth. But that subsector is industrial hemp. So we're now starting to see a number of companies that are creating processes for decortization of the plant to create apparel, to upset the plastics market. So we're starting to see some, and quite frankly, when you start to look at the TAMs in those spaces, they dwarf most of the regular cannabis business and certainly the broader ancillary space.
Well, I'm glad you mentioned that, Jeff. We obviously had a panel on hemp and CBD. Like to hear from Paul and Jeff as to what is Salvio and Credit Force attitude towards the hemp and CBD market, which has obviously been crushed in the last year. And are you looking at investments there, or is it a market that is just too flooded, or are there opportunities? Jeff, maybe you can start, and then Paul can jump in.
Yeah, sure. I'll try to answer both questions quickly. So what we are currently we look at deal flow across the entire ecosystem from, like I said, ancillary brands, MSOs, SSOs. We have a biosynthesis portfolio company. So we look at everything, but where we're most focused of late has been MSOs and SSOs, and more on the private side. Obviously, you could buy Cura, which is great. We were grassroots investors, so we're big fans of Mitch and grassroots and the Cura team. So, you could buy Cura or GTI, Cresco, Trulieve, and do well there. But we're looking at, and we have been making investments in private MSOs, so fully integrated MSOs and SSOs. And so SSOs, we like a few in Michigan. We like California's still a bit of a mess, but we think a couple will emerge from California. And then most people know the private MSOs. Ascend, Holistic, PharmaCann, Verano, Calyx, and so forth. So, we think, I'm more bullish on the space than I've ever been, having done this now for about 6 years. I think this election is going to be transformative for the industry. I think the industry is at a massive bullish inflection point. I think that, we're on the cusp of the U.S. capital markets opening. That'll open up all the Robinhood traders. I mean, just imagine, if Robinhood traders could buy, Trulieve, Cura, GTR, Cresco right now. They can't because it's OTC in the U.S. So that's going to open up, much, much more liquidity and valuation creation and enterprise value creation than currently. And so some of these tier 2 publicly traded MSOs are going to rally massive as a result. And then when these private MSOs and SSOs, are able to go private or go public or get, purchased by a publicly traded one or a SPAC, that's interesting to us. Hemp and CBD, we do have some pure play CBD brands in the portfolio. We're still very excited about them. They've been around for a while, so they're doing very well. We're not making any new investments in the hemp space. The FDA is totally screwed it up. There's just a lot of uncertainty. It's a massively competitive space, and unlike THC, marijuana, hemp as a crop is just already massively commoditized and will continue, able to go across state lines. So it's such a race to the bottom as far as cost of production. So we're not focused on hemp right now. We're focused on MSOs and SSOs.
Paul?
Just Frank, to make a clarifying statement. We do look at the hemp markets as CBD extract as one sector, but industrial is a very different one. So I echo Jeff Howard's sentiments on CBD and brands. I mean, it's incredibly crowded. If this was 1920, I'm not sure I could tell you whether Coca-Cola or Royal Crown was going to be the winner. I'm certainly not able to do that from one brand of, CBD hemp extract versus the other. But I think the industrial side of the hemp equation, which is really in its infancy, given all that's going on with, an effort for ESG and sustainability, and just the clear benefits of hemp as a building material due to its properties, or a plastic replacement or a replacement for fabric, and all of the societal benefits of that is going to be an enormous opportunity. We've not seen as much as we'd like there yet, but I'm of the belief that is going to be really an industrial revolution that's coming, maybe not in real short order, but in short order.
Paul, you wanted to throw your...
I'll chime in. So on the investment side, I mean, our focus has and continues to be on limited license states, but more so these days, it's leading brands in California and really craft cultivation experts in California, where that process could scale into other states, and then a brand that could lead the charge into other states. That California Cool. There's lots of examples of California Cool brands that have transferred in and out of California. And then thirdly would be states that are about to upshift into a recreational framework, that being Arizona, New Jersey, and Florida. Those are markets that really appeal to us. On the CBD hemp side, we luckily have dodged lots of bullets in that space. Came close to several investments. Feel very fortunate to on third base did not come in to score the run. And but for us, it's all about the 2.0 leadership, the new executives that will hopefully take the reins and for crowded space with a lot of bad actors. And for us, it would start with some real leadership at the executive level, which with proven leaders that have done it in CPG, that have done it in consumer focused facing brands. That is where we would be interested when and if that happens.
Okay. Greg, we talked about governance, different kinds of terms. What are you seeing, with respect to structure, particularly taxes? Are always an issue with 280E in investing, in transactions. Hasn't changed much, I assume, unless you're starting to see different ways that have evolved in addressing tax efficiency.
We haven't seen really changes in structures. Structures from the deals we've been working on have been more dictated around transfer of licenses. So that's been kind of the overriding factor in most of these deals setting up. In terms of other deal structures, as I mentioned, we're seeing earnouts, seller notes, purchase price adjustment mechanisms. In terms of novel new, 280E mitigation, I think most firms have tried to run these to ground. I mean, there's one that we've heard about coming up more and more now, and maybe it's because, certain advisors are pushing this in terms of code section 471C, I think it is. I'm not a tax guy, but this is a code provision that applies to small businesses that if you employ this technique, which we don't agree with, you can claim that more should go into cost of goods sold than what otherwise could be. But we think that the IRS is going to reject these positions. So we advise our clients not to try and take advantage of that.
And obviously, who knows what happens post-election. It's still several years away. I think we all agree with deschedulization. So 280E is still going to be something that we're all confronted with, for quite a while. With respect to the capital and raising capital in this pandemic, Cody addressed it a little, but Jeff, is Salvio raising a new fund? Credit Force is raising capital. Jeff, you talked to me about upsizing the seed fund. How are you gentlemen experiencing the ability to raise capital in this pandemic? Why don't we start with Jeff? Jeff Howard. Or Jeff Finkel, I don't care. Either Jeff.
I'll just go quick. Jeff Howard here, Salveo. So when COVID hit, we shelved our plans temporarily for Fund 2. So we didn't go out and we weren't out in the market and then shut it down. We never did it because of COVID. And so that's where we are with Fund 2. We still have capital that we're deploying out of Fund 1, and then in this interim period, which we've been, quite successful at for specific deals, co-investment opportunities that we've put quite a bit of capital into specific one-off deals during COVID. So everyone has their own experience. We're not out in the market right now. The election is obviously, COVID is still an uncertainty. The election is coming. So we'll see where we are after the election. Our thought was, and I think we're right, that, it's a tough capital raising environment for private funds because, there still is very little institutional money. And so you have high net worth and you have family offices that now that, they really could just buy Cura, GTI and Cresco and Trulieve and get the exposure that they think they want. So, raising capital, even though we're not currently doing it right now, I think is a tough thing in a private fund. Having said that, there's still a lot of money that wants access to the space, and that's what I'm saying. I think, guys are looking at specific deal flow now as opposed to just a blind pool in many respects. So I think that'll change again. I think, as the industry comes out of the election and comes out of COVID, I think it'll change again. There's ebbs and flows, but right now I think there's more focus on individual deal flow as opposed to raising private capital in a blind pool fund.
Paul, anything different?
Yeah. So
go ahead, Jeff.
No, Paul.
Yeah, I mean, the first comment I would make is it's so hard to manage the 6-second delay. Yeah, you never know who's speaking. But just quickly, I'll speak for a minute. So the collective fund, I think, has sort of benefited a little bit from COVID on the acquisition of limited partner members, in that a lot of them made bad decisions in the first wave of investing. and understand the value of being a collaborative decision maker versus a go-it-aloner. So enjoying sort of the broad expertise among the membership, and then sort of the institutional due diligence practice that we do. And certainly they give up some independence because they're not voting for their own pocketbook. As an LP in the fund that has committed capital, they're voting on behalf of the treasury of the fund. So I think we've been able to attract some people that are still interested in this space, still view themselves as, Mr. Wonderful on Shark Tank, but like the notion of the institutional safety net that we provide them. As far as our next fund, so Frank, as you alluded to, we are raising our seed early growth fund, our $30 million fund, and we are doing that in partnership with Entourage Effect, who is the lead investor in ArcView, where they're going to be a co-GP so that they can focus deploying capital out of their fund proper at the growth stage where they're writing, $8 to $10 to $12 million checks. But we're going to sort of serve as the scout fund and seed arm of them. We did delay that. We were supposed to be out late Q2 with a book to be able to bring that in, but obviously in light of COVID, we pushed that, and we'll be out in January, Q1 of next year, bringing that together.
Paul?
Yeah, I mean, I think there's more interest from the family offices. I think there's a fear of missing out component from a number of family offices that want a bigger allocation to the space. The high level headlines from a Biden presidency and a Senate that goes to the Dems are all positive tailwinds for the business, and I think there's more of that coming. But the large institutions are still on the sidelines, and then for us on the senior.
Oh, we're losing him. Can you hear him?
Challenging.
Hey, Paul. Paul, I need you to rewind. We lost the audio.
Where did I cut out?
About 10 seconds ago.
Okay. Yeah. That's confusing because with the 6-minute delay, that's 4 seconds. So for us, I mean, I was just saying the family offices are more intrigued these days. I think the tailwinds from positive headlines are getting them more involved, and there's a fear of missing out component from them. The institutions are still on the sidelines. They're if anything, they're doing it inside investment vehicles. And then for us, we have a large backer from a European fund that's our backstop for capital. But we're going to be more keenly focused on the senior secured debt side, where we think there's a lot of interest in. To us, it's kind of the ideal way to invest in the space, where you have the downside protection and you also have the upside participation with the equity warrants. So to us, it's the best of both worlds in terms of investing in the space to have that protection and also participate in the upside of the companies.
So, speaking to the audience, each of you on the fund side in particular, we have a variety of people out there looking for capital. What's the ideal transaction that Salvio is looking for today? What kind of deals would you like to be seeing in this marketplace, Jeff?
Yeah, I mean, we look at deal flow every day. So, we continue to look at the whole spectrum from ancillary to, like I said, private SSOs and MSOs. I'm trying to think of the right way to answer your question. I mean, so we look at the whole gamut. We're like others on the panel. We're past the the pre-revenue stage. So we're looking at a little bit later stage growth equity stage companies that have real revenue and have a real path to profitability. But again, we're still our every single deal, and we do every day. We can see a tremendous.
What's an ideal check size? Jeff? An ideal check size?
For us, the last few portfolio companies have been somewhere between 3 and 5 million.
Okay. Paul?
I mean, I think it's all the stuff that we've kind of touched upon today, right? It's like Jeff said, profitable companies, ideally even producing cash flow, even better, even after tax, which is a hidden expense that a lot of companies don't. Some companies don't even accrue for it, and some hopefully are paying those on time. And then it's just strong management teams, right? That can really, it's a really special person to guide a cannabis company. You have to wear so many different hats from the grow side to the brand side to there's so many different hats you have to wear. So it's finding that leader that can take the company to the next level, that 2.0 kind of CPG leader. And like we touched upon earlier, I think there's going to be an increased focus on audited financials. I think that is going to be key, especially with the resurgence in the SPAC space. That's a requirement to have the 3 years audited financials. I think so. Having these companies that have a solid foundation of corporate governance and audited financials, that's a smaller list of companies to really invest in. But they're out there, and if they're not there, investing in them with the mandate or with the requirement for them to get on the tracks of having audited financials and really fixing their corporate governance issues that a lot of times are solvable if they want to. But when there's founders and a board that's really stuck their heels in, or there's dissension at the board level, it's really hard to move the ball forward. And those are companies that I think are going to lose in the long term.
Well, you mentioned one thing I'd throw out to Greg as we near wrapping this up. SPACs have seen a resurgence this year. What are you seeing in that space, and do you think that they're going to continue to be a player as a source of capital, particularly on the acquisition side?
Yeah, we have seen an uptick in this space. We've come across a few deals, but I think there are a number of challenges around attractive assets in which to deploy the funds that you've raised. I think that's probably the biggest challenge.
Yeah, it'll be interesting to see the sustainability of that. I appreciate everyone coming together in the laboring oar. We lost 4 of our panelists to technical difficulties, but we appreciate you gentlemen taking us through to the finish line. Look, capital is, as we know, a rare commodity in this space. As the election looms, a number of us think that is going to change dramatically, as we've heard from this panel and from prior panels. And to those out in the audience who are looking to raise capital, right now it's still a lot of high net worth family offices, those kind of relationships. To those who are looking to raise capital for their companies, these are the funds that you definitely should be considering. We have our capital connection today, where we've got a number of companies that we've been able to connect with these gentlemen and some of the other funds that you saw earlier. And it's all about networking, and it's about getting out there and making the right contacts. And we hope that we've introduced the audience to some major players here today, key players who are fueling this industry. We appreciate your time, and it will be very interesting to continue this dialogue within a week and see how things are going to shape up for the next 12 months ahead of us. So thank you for joining us. I appreciate the panelists' time. I appreciate everybody in the audience joining us today. We hope you found this conference useful. We hope that you've made some new contacts, and we look forward to hearing from you with any follow-up questions or opportunities or needs. And want to wish everyone continued safe goings and travels throughout these unique times that are confronting us all. Thank you. Thank you. Bye.